Hey guys, it's Alvin here, and today we're meeting with Chris Lopez, who's a portfolio management expert, often appearing on platforms like Bigger Pockets. Today, we're going to be talking about the challenges in today's market, and also we're going to be talking about how build to rent, this is buying new construction properties, often with interest rate buy downs, can be the easiest path from identifying a cash flowing properties. If you want to see more videos like this, hit the like button, hit subscribe. Now let's get going.
Hey everyone, Chris Lopez here, and I'm excited to do a dive into one of the opportunities that makes sense in today's high interest rate environment. Like we've discussed over, videos and masterminds, the market has changed, and a lot of the opportunity we see in like the appreciated markets, the Colorados, the Utahs, the Nashvilles, those markets. The old playbook no longer works in today's market. So one of the strategies that makes a lot of sense is looking at out-of-state markets and combining that with new build properties. So you get a lot better cash flow in these secondary markets, and you pair it with some new build, low maintenance, and right now markets some really good incentives. An expert who is a deal maker in the space, actually met at the last BP Con in Cancun. We connected there. We've been talking since. He's developed an amazing niche in connecting investors with some of these amazing new build opportunities. So, Alvin, can you fill us in on your background?
Yeah, so thanks for having me on. My background is in corporate sales, and I did a number of fix and flips with my father. And then obviously, when I had a chance to do my own, we did. And so we started off being huge fans of Dave Ramsey. My wife and I were able to pay off over 200K of our student loans, able to pay off our cars, able to pay off our house. We were 100% debt free. And then I found myself with almost 3 years worth of income just sitting on the sidelines. And so I asked my wife for her blessing to quit my corporate job, and she gave me her blessing. So then I began the journey I became an agent really for my own inventory, for my own buying and selling of properties. And then just over the time, people just kept asking for help. So very quickly, I created a company where I was helping out-of-state investors invest in the markets that I was in, which is mostly Florida. And this was mostly helping them buy under value, rehab them, and rent them or sell them. And one of my best clients who bought 12 properties from me said, "Hey, Alvin, what about new construction?" And I was pushing him off. I kind of had that immigrant, my father and we did all the labor ourselves, and I thought every deal required to put the sweat equity into the deal. So I told my investor, "Hey, this is a bad idea. Here's why, et cetera, et cetera." He's like, hey, Alvin, I think this is really a better approach. So we went ahead and did it. He started with one, then he bought four. Then I had another client say, "Hey, Alvin, do you do new construction?" I said, "Yeah, I guess I kind of do." And very quickly, we got to the point where over 80% of the inventory that we sold was all new construction. And what I learned is actually my approach was not as smart as a newer approach. So oftentimes you can buy new construction properties for a cheaper price than you can an existing home because builders have to sell on volume. They can make less per deal. A homeowner who lives in a property is trying to get as much as they can per sale because they only have one sale. The other thing is that insurance rates are a lot cheaper. Insurance ends up being about 30% cheaper than an existing property. Rents are also higher. Repairs and maintenance are also a lot less. And overall, your appreciation is going to be a lot higher if you're investing in a fast growing market. So all of the benefits swung towards new construction. We rebranded a couple of years ago to focus on the build to rent space. We're called Build to Rent with the number 2, which is really good for SEO. But really what happens is that if you talk to most investors, they are very aware that buying real estate properties is the best way of creating wealth compared to stocks, bonds, or anything else they can invest in. The challenge is that real estate is very difficult. It's very cumbersome. And it's an annoying process. So if you go to a traditional real estate agent, they're going to go shopping with you, which is a huge waste of time and feels like, you're doing most of the work yourself. Our approach is the exact opposite. We start with inventory already. So we've already pre-negotiated on duplexes, quadplexes, single family, and even larger community. Some of these can be as small as 16 units up to all the way to 180 units. We have several different inventory models for our investors, but the goal that we have is to reduce all the friction that's involved in a real estate transaction so that buying new construction properties can be as easy as buying a stock or a bond or anything else.
Yeah, I love it. I agree with everything you said there. And, an angle I look at is the trend is your friend. Before I got into real estate, I spent a couple years dabbling in stock market and foreign currency trading. And, that's a popular term in there. I didn't make any money in there, so I switched to real estate. But when you talked about how, like what you used to do, you'd go in there and find these values and you'd put sweat equity and, physical improvements in the property. That was the play in the last market. That's how you created value in that market cycle. You could go out there and find properties that were underpriced, needed love, and then go in there and increase a lot of the value, and a lot of times pool, all or some money out, like the old Burr strategy. Well, now that opportunity no longer exists. I love the opportunity. Alvin loves the opportunity. The market doesn't care that we love it, and that so many other investors love the opportunity. So now it's like, okay, the market's doing this. How can we adapt? And the areas that we can find value, and like a lot of times that value creation, in this case equity creation, is where you can get new builds for cheaper than resale or at a discount, since the builder needs to sell a few bulk off to investors here. That's how I view it as an opportunity. Now, you're not going to be able to pull out all your money like in the old Burr strategy, but also in this case, you have to do like zero work other than your basic due diligence and basic management, all that stuff on a brand new property. But you can go in there and create value. I mean, Alvin, what would you say is like the average discount, if you know that, like from either the resale market or what the new builds are typically selling towards a owner-occupant customer?
Yeah, so when we do these deals, we're always trying to negotiate with the builder to find the best option that would excite our investor. So our goal is not to have 2,000 options for our investors. We want to just isolate the best opportunities that we can for our investors. And so what happened was 3 years ago, when interest rates were lower, we would negotiate heavy on price. That would be our number one get, because we're in an appreciating market, and that's what the investor wanted at that time period. Now the appreciation isn't there, and that's actually not what a lot of investors are focused on. Right now, the biggest challenge in the industry is finding deals at cash flow, and that mostly comes from the interest rate. So cap rates are about the same, prices went up 20%, rents went up 20%. What's killing the idea of finding a good investment is cash on cash, and that's mostly tied to the cost of capital. So if I give somebody a $50K discount on a property, it sounds great on paper, but if I add an 8% interest rate, that deal's still not going to work. So we have to put a heavy emphasis on the interest rate. So when we negotiate with these builders, we're often negotiating free property management for at least the first year or second year. But more importantly, we're also negotiating on the interest rate. And the way that we do this is a way that's very complicated, but we are in the business of solving challenges. And so we're able to get our investors interest rates as low as 3.75% when the prime for an investor is like 8.2. So we are going back in time with the interest rates to make it so that these deals work. Right now, if you're looking at your portfolio, the number one thing people are lacking is cash flowing deals. And it's the number one reason why most investors are sitting on their hands. So can we offer a discount? Yeah, 5 to 10 is a norm, but more importantly is finding deals that cash flow, and we have plenty of those.
And I love that, because hey, we get cash flow today, which you always need to pay the bills, and ideally bring in a nice monthly profit. And then long term, great, if you're buying a property, you get a 50, 75K instant bump in equity. Hey, that's very helpful for down the road once it's time to go out there and extract the equity. I like this play a lot, like in the current market cycle, and how I see a lot of the kind of like the strategic chessboard, how a lot of investors could use this. Like I'm in Denver, hey, we've had huge appreciation, and a lot of investors out there, it's like, hey, where's the next place I can go to get cash flow and to kind of ride that next growth wave, right? Like Denver's growth wave is over. Salt Lake City's growth wave is over. Austin's is over. Hey, what's the next places, the next areas, the next towns? Hey, there's the next growth wave as people move from our now expensive markets to the less expensive markets, right? That's just the way that it goes. So, hey, invest in that market dynamic and hopefully ride that growth trend and get like, above average national, growth and all that. And then, hey, you buy a new build. What I like about it is from like the return equity standpoint, anywhere from like 3 to 7 years, a lot of times like, like 5, 6, 7 years off of like the ideal time to like pull out your equity or do a 1031. Hey, buy the property, hopefully capture a good chunk of this recovery and market expansion in a growing market. The first, 5 to 8 years of new builds, you have almost, zero maintenance with the builder's warranty for a lot, for a period as well. And so from a long-term standpoint, hey, in 5, 6, 7 years, it might be a great time to exit that before you get a bunch of deferred maintenance. You caught some of that market pop. Now your return equity is maybe getting, not in the green anymore. And then you go out there and repeat that. It might be another build rent property next market. It might be whatever the next market trend does. But that's how I kind of view this in the macro. And I think it's a really good opportunity for people out there that want the 1031 tax advantage, especially with the new builds, a lot less stress and timing headaches since it's a new build property. You still want to stay hands-on, in terms of like, hey, plugged in and just, hey, you got to still manage the numbers and, stay focused and make sure you're doing proper asset management, but can ride a really good trend to keep, high ROE, get cash flow today, and I think we're at a really cool trend in the market cycle.
You said a couple of things that were very important. Great for 1031 exchanges. The majority of our inventory is within 3 months of being completed. So they're already at that finish line. So when we say new construction, we're not saying ground up construction. We're not saying we're going to have you buy a land, go under a construction loan, wait a year and a half and do that. It doesn't make sense in today's market. You're missing out on cash flow, the tax benefits, and the debt pay down. Doesn't make any sense. So instead what we're saying is buying a property that's already being built, already near construction, you're going to take over once it's completed. And a lot of these are going to be in markets that make sense today. The reason why Colorado doesn't work, to be blunt, is the land cost. The land cost is way too high. When you also have high land costs, you're also being very speculative because the land cost is completely made up. It's not the actual cost to build something. It's a made up figure that in an up cycle will go up and a down cycle will go down, but it's a mostly made up number, the land value. So we focus on markets where the land is cheap and the rents are high. Usually these are tied to magnet, larger cities that are maybe a little bit more expensive, that still have a very strong economic base, but it's where the growth is obvious and it's where it's going next. So we like finding those areas adjacent to a major city that it's still cheap, still affords, but it's going to take that longer ride to appreciation. We always avoid markets that are being gentrified or have older inventory because that older inventory acts as a wet blanket to the market. They're going to show up on your comp and it's going to kill it. So we like to be in the average of the market, but prefer that properties around them are actually being built to a higher scale. These are like more bedroom communities where your neighbors are going to have a pool, they're going to have an expensive landscaping package, and that market appreciation is what's going to drive the value to your property.
Cool. So Alvin, I know a lot of people at this point, if they're listening to us, they're interested. As for a lot of our people, they've probably seen Property Llama, done some high level modeling, say, okay, hey, these numbers look like the old day numbers, in terms of trade up. So as they reach out to you and connect with your team, what's kind of the process? What are the next steps you and your team do to get to know the investor and start the search?
Yeah, so we work more as a consultant. So we're not going to push any one recommendation or one product. We want to get to know your story. We want to understand what your goals are, what your objectives are, what your fears are, what your long-term plans are. And we can also run through the Property Llama tool to see what the best use of other properties. So we're going to play with different scenarios to say, hey, if we sell this one, who maybe you have a lot of trapped equity in this deal, what could you get as a result? A lot of investors would hold on to trapped equity properties because they don't feel confident they can replace the property. So if we played with the scenarios and we found a replacement property, a lot of times it gives the investor the idea of saying, okay, you know what? In a few months, I feel comfortable selling this property because I know I can identify another property within 45 days. And so if the entire exercise is just figuring out hey, can I find a substitute property? And the answer is yes. Now you can release the trapped equity and you can probably buy multiple. So we actually had a VP of Microsoft who actually sold one property in Washington State and was then able to buy 5 properties here in Florida. And now he's retired in Egypt. One deal can be translated and multiplied into multiple. So if you're in a situation where you have trapped equity, you want to definitely use the tools that Property Llama has available for you. But then ultimately you want to figure out, hey, how many other properties can I do? And then more importantly, what's the impact to my wealth long term, having exchanged one property for several?
All right, guys, now I want to hear from you. Have you heard of build to rent? Is it good? Is it bad? If you were to sell your property, would you consider buying a build to rent property? Ask your questions below in the comment section. I'll be answering each and every one of them. All right, guys, that's all for today. I'll see you next time.